If you're one of those people that pore over graphs, economic statistics, or astrology charts, trying to figure out what the stock market is going to do next, you are wasting your time. No one can predict the market.
Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So in today's video, I'm going over some investment principles from legendary investor, mutual fund manager and philanthropist Peter Lynch. For those unfamiliar with Lynch, here's the short version. Over a 13-year period, he absolutely destroyed the S&P 500 returns in the fund he was managing, averaging over 29% per annum for more than a decade running. In other words, the dude knows what's up. I know a lot of you watching the channel are actually Tesla stock investors, so what we're going to do today is actually apply some of Peter's stock investing principles, his philosophies and ways of identifying opportunities, investing in stocks, etc., specifically to Tesla as a case study. This is going to be really fun. So let's have a look at what Peter has to say. But before we do, hey guys, if you're in the US and you'd like up to 2 free stocks, check out the link in the description to WeBull. If you open a new account and fund it with $100, you get 2 free stocks, one of them valued up to $1,400. And if you're in Australia, the UK or New Zealand, you can get a free stock with stake using the link in the description. Let's get back to it.
You have to understand the market goes down. There's been 95 years this century. We've had 50 declines of over 10%. Of those 50 declines, 15 have been 25% or more. So about once every 2 years, the market falls 10%. About once every 6 years, it falls 25%. These are big drops. You have to understand that. That's the nature of the market. In 1990, Saddam Hussein went into Kuwait. The banking system was in trouble. We had a recession. You had all this background noise. Lots of good companies had nothing to do with wars, nothing to do with banking. They all went down in 1990. The market fell from 3,000, it fell over 20%. This gave you a great opportunity to buy terrific companies at very good prices.
Boy oh boy, those words sound really familiar. Almost like the script to a few of my videos that I posted in March and April explaining that the world wasn't ending, that some companies had been disproportionately impacted by the panic in the markets and they shouldn't have been. I made an example actually that the Tesla share price had fallen about the same as Delta Airlines. Did I really think that Tesla's business was going to be as impacted as airlines during a global pandemic? Clearly not. So I loaded up very heavy, bought a lot, and my returns reflect this. I've absolutely cleaned up on those purchases made through March, April, May, and June. It's not a surprise. Why is that? Because I understood the story of the company. I wasn't getting swept up in the panic. I wasn't thinking, oh my God, the world's ending, everything's over. I was thinking, hang on a minute. Tesla has way more demand than they can meet. They're growing, they're scaling, they're very profitable. They don't have to advertise. They sell every vehicle they produce. They sell online. You can do contactless deliveries. Man, they're going to clean up here. They're going to continue to sell. They don't have dealership networks. They don't need to keep these open. They can keep selling vehicles online. It's going to be perfect. And sure enough, Tesla powered through the pandemic, sold every vehicle it produced, continued to build factories on multiple continents, reported a 4th consecutive quarterly profit, and is now eligible for S&P 500 inclusion.
Behind every stock is a company. If the company does terrific over a long period of time, the stock will do terrific. If the company does lousy, the stock's going to do lousy. That's all you're betting on. Look at Fannie Mae. From July through October 1990, the Standard & Poor's 500 fell 21%. Fannie Mae fell from about $42 a share to about $26, even though earnings were still increasing. This was a terrific time to buy Fannie Mae. The company was doing well, management was still great, the story was solid, and they had a very good business. But you got to buy the stock at a 38% discount.
Sound familiar? Tesla's stock dropped about 60% during the height of the recent panic. Didn't make any sense. I really feel like I've missed a trick here with Peter Lynch. To be honest, until recently, I only had a cursory understanding of who Peter Lynch was. I understood, yes, he's a great stock investor, got great returns at his fund, has written some books, awesome, but I didn't really go much deeper. And it turns out that was a very poor decision on my part. Had I learned about Peter Lynch and his investment principles and philosophies, I would have saved myself almost a decade coming to almost the same conclusions.
In the meantime, remember, categories are guidelines. They are not hard rules. Some companies may not fit neatly into a category. Others may seem to be in 2 categories at once. Almost all companies change categories at some time throughout their lifetimes.
So remember that one time when people thought Tesla was a car company? They used to compare them to Ford and GM? Oh wait, most of them still are, aren't they? Tesla's definitely not a tech company. No, they're definitely not a solar company. No, definitely don't make battery. No. They're not an energy company. Hell, no, they're definitely not a transportation company. No. They're a car company, yeah. Well done, guys.
It's easier to go from $100 million in sales to $200 million in sales than it is to go from $10 billion in sales to $20 billion in sales. So smaller companies tend to have more upside potential than larger companies. But don't dismiss all big companies out of hand. Some big companies defy their size and find exciting new ways to grow their earnings.
Poignant point from Peter there. God damn, what a tongue twister. But anyway, the point there, he's completely right. Most companies are going to struggle to grow revenue from 10 to 20 million compared to 10 to 20 billion. When the numbers are bigger, it's a hell of a lot harder. But this is a major mistake I think a lot of people are now making with Tesla. People are forgetting a few major things. The first of which is that full self-driving, the software, the robotaxi component, barely touched. The software component, barely touched. The energy component, barely touched. Batteries, barely touched. Solar, barely touched. Tesla is just getting started. The first course was getting some electric vehicles on the roads. The second course is full self-driving. The third course is the world's energy needs, okay? Audible software, I've gone into that. If you want to watch some of my videos, I'll put a link in the description. Point here, Tesla's just getting started. In my opinion, they have a very clear path to continue to scale revenue at staggering rates for the next decade or more.
When most people think about investing in the stock market, they dream about investing in a fast grower, a company that is growing at over 25% a year. At 25% a year, a company's profits will double in 3. They quadruple in 6. They go up 8-fold in 9 years. That's how you get a huge stock in a decade. There's not a lot of these, but they're very powerful. And the best part is, you don't have to catch them just as they're taking off. The beauty of growth companies is you have plenty of time. If they're going to grow for 5, 10, 20, 30 years, you don't have to be there the first year or the second year. You could have bought Walmart 10 years after they went public and made 30 times your money.
Apple, Amazon, Google, anyone?
What makes a company grow earnings so quickly? Either it is a rapidly growing industry, or it's a rapidly growing company in a slow growth industry. Rapid revenue growth and rapid earnings growth are the hallmarks of a fast grower. But you just can't buy any stock with hot earnings and hot sales. You have to check the balance sheet and make sure the company can keep growing. One way you can look at growth companies is think of baseball. A normal baseball game has 9 innings. You should look at a growth company and say, I don't want to buy it when they're in the first inning. I want to buy it when they're in the second or third inning. They've got the formula right. They've got lots of room to go. So you want to say to yourself, this is a company that's very early in its cycle, like a McDonald's when they're only in a few stores, or limited when they're only in 100 stores. And they had lots of malls to go to.
2 really important points here from Peter. The first was that a company can grow its sales and revenue if it's in an industry that itself is growing. Hint, hint, electric vehicles, solar, batteries, need I go on, but it can also be growing revenue sales if it's actually growing within a static or declining industry. Tesla has a double whammy, okay? They're gaining market share, growing sales, and the industries that they're touching are exploding, and we're still like day 1, okay? Global EV sales, just a few % of total vehicle fleet. Solar sales, battery sales, an absolute drop in the water compared to what they'll be in 5, 10, 20 years time. So we're really at the very beginning.
So what are hidden assets? Many companies, particularly old line companies that have been around 20, 40, 50, 100 years or more, have real estate holdings whose true market value is not reflected on the balance sheet in the annual report. In many cases, the hidden asset is the company's name and its reputation.
The concepts of hidden assets is fantastic and really applies to Tesla. So they've got over 1 million Teslas on roads at the moment. Each of these is collecting data and sending it back and training their full self-driving AI to improve. So this is a hidden asset. The fact that they've got this fleet of vehicles is actually out there collecting data for a very important problem, solving full self-driving. That is a hidden asset. Another hidden asset is more of the install base but viewed through a different lens. What about over-the-air software updates like performance improvements or infotainment sales in the future? Again, Tesla can press a button, launch an app site, and suddenly the financial floodgates will open with software revenue. That million-plus fleet of Teslas, press a button, suddenly ride-hailing network turns on and Tesla can take a cut of all of that revenue. All of the solar and batteries that they've installed on houses around the world, press a button, turn on audible software, suddenly you're printing money and helping supply energy to grids and taking a cut of all of the energy.
The price of a stock will follow the direction of earnings. In almost every case, you can generally state that if a company's earnings go up sharply, the stock's going to go up. If earnings go from very poor to mediocre, the stock's probably going to rise. If they go from mediocre to good, it's probably going to have another rise. If it goes from good to excellent, it's probably going to have another rise. Or if a company's earnings grow dramatically over a long period of time, the stock's probably going to go up dramatically.
I read all your comments. People ask all the time, what do you think Tesla stock's going to do? What's going to happen next week, next month? Should I buy before? Should I blah, 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 blah. I have no idea what the stock's going to do in the short term. But my answer is always the same over the long term. I believe Tesla is going to continue to increase earnings. Therefore, the trend for the stock price, most likely the trend, not what it's going to do tomorrow, next week, or next month. The trend is likely to be up as long as earnings are also trending up.
I hope by now you've been convinced that your story should always include an explanation of how the company plans to improve its earnings or to sustain its growth rate over time. There are only two ways for a company to increase earnings. They can increase sales or reduce costs.
We're seeing both of these things happening with Tesla. They're continuing to grow sales at a staggering rate and, more importantly, grow production capacity for future sales at a ridiculous rate. I mean, they're going to be selling millions of vehicles per year in a couple of years' time. Literally, Gigafactory Shanghai expanding, Gigafactory Berlin under construction, Gigafactory Texas under construction. You get the point, right? And Tesla continues to drive costs down as well and pass those on to consumers while maintaining healthy margins. We've seen this in everything from the cost to produce, say, a Model Y, which is far cheaper than a Model 3, it has a higher selling price, thus a much larger margin, to the capital expenditure to actually build a new factory, which again, we're literally seeing this trend down from a few $billion to now around $1 billion. It's insane.
Reducing costs not only pushes up the earnings number, it makes a company more competitive. If two companies both produce competitive products of similar quality, then the one who can build it more cheaply has the advantage. They can choose to charge less for the product and sell more than their competitor, or can sell it for the same price and make much more money than their competitor.
This is a similar situation to the one that Tesla faces, although there is a key difference. Unlike the scenario Peter talked about, Tesla doesn't have a similar product to its competitors. It has a far superior product and their costs are far lower. So not only does Tesla have the luxury of either maintaining margins and increasing profits as their costs come down, but they also have the luxury of undercutting competitors with a superior product, which is exactly what they are doing.
The details of a company's plan will vary by industry and by individual company. Just make sure you understand that plan and include it in your story. Once you've built the story for your company, you have a powerful tool for judging the stock. But like any powerful instrument, you must use it wisely and carefully or you'll get burned. When I pick stocks, I think of risk as a measure of my confidence in the story I've built. When I feel that my story is optimistic, solid, and well-researched, then I've got a low-risk investment.
This is such a brilliant way of describing things I previously didn't really have the words for. There's been many occasions when people have been in my ears, oh my god, you're taking so much risk, oh my god, that's a terrible... Because I had a clear story, there was a few dark areas, I'd had some gaps in my knowledge, so I shine a light in those dark areas. Oh, okay, cool, I know it's there now, not a big thing, not a problem, nothing to worry about, okay, cool. Whereas people who didn't really have the same understanding of the story, because they hadn't looked in those dark areas and lit them up with a torch to actually see what's there, they hadn't thought their way through everything. They were projecting their risk because for them, the same investment would be very risky because of much more uncertainty. I'd gone a lot deeper. Very difficult for me to convey to people sometimes. The same thing with Tesla. People say I'm a moron. There's been YouTubers who've made other videos saying you should never invest like this, or you shouldn't invest like this, or don't invest like this, and I totally get it. That general advice for general people generally applies. But I've done my homework. This is why I was all in on real estate in a few markets in Australia at a period of time and absolutely cleaned up 10x my capital within 7 years. This is why I put a huge amount of my current net worth into Tesla stock. I made this channel literally to tell everybody, hey guys, I think this stock's undervalued. I've published over 100 videos trying to explain my thesis, my story around Tesla. And because I have this clarity, when I see the market decline recently, I'm like, this is a huge buying opportunity. I'm not panicking, I'm not worrying because I understand the company. This is a really important concept from Peter, the idea of understanding the stock story and that actually being a way to reduce your investment risk. Again, the same person investing in the same asset might have a much higher risk, not because the company is any different, the outcome would be the same, but because they haven't done the same homework, they don't have the same understanding. That's unnecessary risk that I try to eliminate. So sometimes people will see something as an extremely risky investment when in fact, from the shoes of the person who's made the investment, it may actually be the lowest risk thing they could possibly be doing with their money. And yes, you can get the story wrong, you can be wrong, or there can be an unexpected chapter, a big surprise that can totally happen, I acknowledge that. However, for me personally, when I'm investing in stocks, I'd much rather be investing from a place of understanding, not uncertainty. I'd much rather feel confident that I understand the story and that I've massively reduced my investment risk than just blindly hoping, not having a strategy, not really having a clear idea. How's this company going to grow revenues? What's the thing look like in 10 years? No idea. Not for me. I really need to understand. But once I do, I make very confident and big investment decisions because I'm not worried about fucking up, because I've looked everywhere I can. I've done everything I can to reduce risk and I'm comfortable to move forward with that investment.
If a startup company sounds exciting, keep an eye on it. Perhaps a year or two later, it will be over the hump, the story will be solid, and there's a good time to consider investing. If you believe strongly in your company's story, then you shouldn't waste your time waiting for the ultimate buying opportunity.
This is just truly uncanny. Second or third video I made for the channel was called Waiting for Tesla Stock to Dip, parentheses, good luck. And the whole point was if you think that stock's going to trend up over time, they keep growing revenue, etc., waiting is a really fucking dumb idea. Turned out to be a really fucking dumb idea, didn't it?
If a story is good, you probably want to own it. Later, if a buying opportunity comes along, the stock falls well below its growth rate, and the story hasn't changed, you can buy even more. Therefore, you can take advantage of market declines.
Brilliant stock investing advice there from Peter Lynch. My only regret is that I didn't discover his principles earlier. I mean, I kind of came to the same conclusions myself, but over years of trial and error and trying to learn and figure out and fumble my way through investing, there's a reason that I didn't read lots of stock investing books when I began investing in stocks. And I saw a lot of the advice, the value investing stuff, and just went, come on guys, this is not going to apply to a tech company that's disrupting the planet. Garbage. So I was very dismissive of a lot of old stock investing wisdom. So on that note, guys, if you've got any books to recommend, leave them in the comments. I'm happy to check them out, ideally if they're on Audible. Better late than never, I guess. I read Peter Lynch's book One Up on Wall Street a few weeks ago and have since been absolutely blown away by how similar we are in our thinking about investing in stocks and other assets. There's a link in the description to the book if you'd like to check it out. If you're not already a member of Audible, you can listen for free with a new trial. So I hope you guys have found these stock investment tips from Peter Lynch insightful, useful, and most importantly, applicable. Let me know in the comments below, guys. Were you familiar with Peter Lynch and his stock investing principles and wisdom before this video? I know many of you will be, and you'll be there with pitchforks. Stephen, how did you not know about this before? I know guys, I messed up, my bad. I hope that in using Tesla stock as a kind of case study for some of these principles, you've really gained some insight into how well they can apply. I only wish I'd discovered Peter Lynch earlier and made this video earlier. I'm Stephen Mark Ryan, this is Solving the Money Problem, and I love you all. And of course, don't forget your free stocks with WeBull. If you're in the US, you can start a new account with WeBull using my link below. Deposit $100, you'll get 2 free stocks, one of them valued up to $1,400. And if you're in Australia, New Zealand, or the UK, you can get a free stock using the link in the description to stake.
Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.